Good morning, everyone, and thank you for joining our webinar on auto enrolment today. My name is Hilary Larkin. I'm a partner in Forvis Mazars and I lead the firm's outsourcing division. In our outsourcing division, we support businesses of all shapes and sizes by acting as an extension of their finance function, whether it's to fill a specific gap in their finance team, to provide temporary secondment support, or take full responsibility for running your financial operations. A core part of that work is payroll, and we have a dedicated team of 30 payroll professionals. Through that, we see firsthand all the challenges and opportunities that employers face when it comes to staying compliant, supporting their employees, and keeping ahead of change. And I suppose change is what brings us here this morning. As everyone here knows, auto enrolment is finally coming into effect in January. Most people probably are up to speed in the general principles of auto enrolment, but many still have questions around the actual operational perspective. Um, while the concept is simple, the practical implications can be significant, particularly where there's no pension policy in place for companies. Employers around the country are adapting their processes, updating their systems, and in the process of issuing communications to employees about auto enrolment. Today's briefing is designed to support you in preparing for this change and to answer any questions that you may have. We're going to start with a presentation by Paul Orde of the Department of Social Protection, who has been an integral part of the auto enrolment programme. Then we'll be joined by our payroll director, Jennifer O'Neill, who will give some perspectives on, from a payroll practitioner point of view, on what the steps that need to be taken. So on that note, I'll hand you over to Paul. Thank you.
So, uh, Thanks very much, Hilary. My name's Paul, and I'm just going to give you a quick overview of MyFutureFund, including the eligibility, the contribution rates, and how the scheme's going to work. Employees who are eligible for automatic enrolment meet these three criteria. The first one is that they earn €20,000 or more across all employments per year. The second one is that they're aged between 23 and 60. And the third one is that they're not already contributing to a pension scheme through payroll. Employees who earn less than 20,000 a year or who are aged 18 to 66 can also opt into MyFutureFund, and they'll be able to do this using the online portal. All employees whose pay is reported to revenue in the Republic of Ireland are potentially eligible for MyFutureFund. So that means factors like contract type and length are not taken into consideration. This means that seasonal workers, part-time workers, workers on probation, etc., will all be considered for the eligibility test and will be able to opt in. People who are self-employed or not currently working and earning, however, won't be eligible for auto-enrollment or to opt in. So now we get a lot of questions about how auto-enrollment will work for someone who has multiple employments. And sometimes what we find is that an example works better than a long-winded explanation. So in this example, the employee has two employments. In job A, they have a gross pay of €10,000, and in job B, they have a gross pay of €15,000. So although they earn less than €20,000 in both of these jobs individually, their aggregated pay of €25,000 is taken into consideration for the income threshold. Therefore, they're eligible to be auto-enrolled. The employee will pay contributions for both employments, and each employer will pay contributions as a percentage of the gross pay that they pay their employee. Now, as you'll see in a few minutes, in the first few years of MyFutureFund, the employee and employer contributions will each be 1.5% of gross pay, and the state top-up will be 0.5% of gross pay. So in this example, the total employee and employer contributions are each equal to 1.5% of the employee's total gross pay of 25,000, and the state top-up will be equal to 0.5% of their gross pay. And this equates to a total annual contribution of €875 towards the employee savings pot. So just to take another example, and in this example, an employee is already paying into a pension scheme through payroll for job B and will therefore be exempt from MyFutureFund for that employment. Now, this means there'll be no contribution to MyFutureFund in respect of that employment. However, the employee's gross pay for job B will still be taken into account for the income threshold, and they'll still be automatically enrolled for job A where there's no existing pension contributions. Contributions will be paid by the employee, employer, and state based on gross salary of €10,000, and this equates to a total contribution of €350 towards the employee's MyFutureFund savings pot. So although assessing the income threshold in this way does add a layer of complexity, it means that people who work multiple part-time jobs won't lose out. And employers won't necessarily need to know if their workers have another job because they won't be deciding who's eligible or enrolling them into MyFutureFund. But as I'll explain later, NAERSA is going to determine this. However, it is something that employers should be aware of. So the contribution rates will be fixed as outlined in this table, and it won't be possible to contribute more or less than these rates, at least in the initial years of the scheme. Employers will match their employee contribution, and the state will provide a top-up in lieu of tax relief on the employee's contributions. To help everyone adjust and get used to the extra costs, contributions will be phased in over the first decade of the scheme. They'll start at the low rate of 1.5% for the employee and employer and rise by 1.5% every 3 years until 6% is reached in year 10. Important to note that the phasing in of contributions will take place in the first decade of the operation of MyFutureFund, not in the first 10 years of an employee's career. If an employee was to join the scheme, we'll say in 2033, they would start paying at the 4.5% rate, and any employee who joins after 2035 will be on the 6% rate. All contributions will be calculated on the employee's gross pay before deductions, and the employee's contribution will be taken from their net pay. So this means anything that's included in the gross pay field will be assessable for the contribution rate. Now, to help ease the cost of contributions, they'll be calculated up to a maximum gross pay of €80,000. Contributions will be stopped by NAERSA through a payroll notification for the remainder of that year after the threshold has been breached. So I'm just going to give you a brief overview of the opt-out or suspend contribution options. And if you'd like more detail, there are videos available on our YouTube channel that go into a bit more depth. The opt-out window will be available in months 7 and 8 after enrolment or re-enrolment, and also in months 7 and 8 after a contribution rate change. When an employee opts out, all contributions will stop, including those from the employer and state. A full or partial refund will be available to employees based on their own contributions, but all of the employer and state contributions paid up to that point will remain invested in the employee's savings pot. In addition to opt-out, employees will also be able to suspend their contributions at any time outside of the mandatory 6-month participation period. Employer and state contributions will also be paused for the duration of the suspension. Employees won't get a refund of contributions in this scenario, and to ensure that employees don't opt out or suspend and forget to come back, they'll be automatically re-enrolled after 2 years, provided they still meet the eligibility criteria. Employees will be able to apply to opt out or suspend through the employee portal, and NAERSA will keep a track of who's due to be re-enrolled. Employers will be notified of the change through an updated payroll instruction. So, the pot follows member approach is a key feature that was designed based on learnings from other countries. It means that employees will have one savings pot in the system even if they move jobs a lot throughout their career. It eliminates the burden of multiple pots and the potential loss through fees eroding small pots. To ensure that everyone's savings go as far as they can, they'll be invested. The investment management companies have been chosen through a procurement process to use their expertise. Sorry. Sorry about that. To to grow the employee savings. The preferred bidders are Irish Life Investment Managers, Amundi, and BlackRock. The investment managers will each provide a high, medium, and low risk fund that will make up the 4 fund strategies available to participants. As well as the high, medium, and low strategy, there'll be a default strategy that everyone will be placed in to begin with. The default strategy will operate on a life cycle basis, which means the investment risk is decreased as the participant gets closer to retirement. It takes advantage of low risk growth in younger years and the stability of, or high risk growth in younger years and the stability of low risk closer to retirement. Default strategy will allow participants to get a good retirement income without having to make choices or decisions. Those that do want to choose will be able to switch to the high, medium, or low risk strategy. And after all the saving and investing, employees will have built up a pot for retirement. The retirement age for MyFutureFund is linked to the state pension age, which is currently 66. In the initial years of the scheme, retiring employees will receive a lump sum payment from their pot, and in the future, as more retirement products get developed and will become available to retiring employees. Unlike systems in other countries, employees won't be able to access their pot before retirement age. This is to ensure that their savings are ring-fenced for retirement. Early drawdowns will only be possible in the case of an ill health retirement. In the unfortunate event where an employee dies prior to retirement, their savings will be crystallized and will form part of their estate. So as I mentioned before, A new savings body called the National Automatic Enrolment Retirement Savings Authority, or NAERSA, has been established to administer MyFutureFund. NAERSA have a board that is answerable to the Minister and Oireachtas, and it will be supervised by the Pensions Authority. The body will bear the bulk of the administrative burden. And just to give you an idea, here are some of the main functions. NAERSA will determine employees' eligibility for the scheme using revenue payroll data. They'll inform employers through an auto-enrollment payroll notification, or AEPN, when the employee has been enrolled, and that notification will contain the contribution percentages to be applied. NAERSA will collect the employee and employer contributions from the employer and will collect the state top-up separately. They'll manage the employee savings pot, and this will include managing the administration of the opt-in, opt-out, and suspension options through the employee portal. NAERSA will also manage re-enrollment and exempt employment where an employee has started paying into another pension scheme through payroll and update the APN accordingly. They'll manage the contract with investment managers, ensuring that they are complying with its terms and conditions, and NAERSA will pay out the savings pot to employees at retirement or to their estates in the event that they've passed away. It will monitor compliance with the legislation, and for employers, this means paying contributions on time and not forcing employees to opt out or suspend their contributions. NAERSA will also manage the public website with information on MyFutureFund, as well as the employee and employer portals. Employees will be able to view their savings and execute choices, while employers will be able to check their contribution record and update payment details. The contact center will also be available to both employees and employers. So this infographic just gives a little overview of how the system is going to work. Contributions will be collected by NAERSA, who'll then pool and allocate them to the investment managers according to the employee's investment strategy. The investment managers will invest the contributions and generate returns, which will then be allocated to the employee's savings pot by NAERSA. NAERSA will pay out the value of the employee's savings to them on their retirement. So I'll just explain this process in a little bit more detail. NAERSA are going to use payroll data from revenue to identify eligible employees. And this will be pretty quick for employees who already have an earnings record, but it'll take up to 13 weeks for new employees who have no earnings record. The look back is a review by NAERSA of revenue payroll to see if an employee is eligible to be auto enrolled. For this 13-week look back period, the annual threshold will be prorated so that once someone hits €5,000 gross pay, they'll be enrolled. The 13 look back period is on a rolling process. So even if an employee doesn't qualify initially, NAERSA will continue to monitor in case they do become eligible. NAERSA will send the auto enrollment payroll notification, or APN, to the employer via payroll software for each employee that's enrolled. And the employer or payroll operator will get latest APN and apply it to calculate the contributions. The employer or payroll operator will then return a contribution file to NAERSA, and NAERSA will use this to ensure that the right amount of contributions are collected. The employee and employer contributions will be collected from the employer, and there's going to be a couple of payment methods for this. But the easiest way for employers to pay will be through a variable direct debit, which they'll be able to set up on the employer portal. Once NAERSA has collected all of the contributions, they'll be pooled and sent to the investment managers. So to make it clear what employers and their payroll operators will have to do, I'll just quickly go through the process from their points of view. Employers or their payroll operators will get latest APN through the payroll software. They'll then apply the APN and return the contribution file through the software by 6:30 p.m. on the employee's pay date. Employers will have to make sure that they pay the contributions on the same day that the employee is paid. And again, the easiest and quickest way to do this will be to set up a variable direct debit on the employer portal. And if it's the first time an employee has been enrolled, employers will also have to notify them of this and of their enrollment date. So because NAERSA is going to be managing the bulk of the administration, there's going to be less work for employers involved when compared with running their own occupational scheme. In fact, MyFutureFund will be as easy as 1, 2, 3. And this means that we're asking employers to complete 3 easy steps before January 2026. Step 1 is to complete your MyFutureFund employer portal profile when the portals open in December. And this will mean filling out some basic details for your company, like name, address, and the contact information. Step 2 is to set up a payment method for the contributions. The best option to make compliance as straightforward as possible would be to set up a variable direct debit, like a lot of employers already do for revenue. This gives the advantage of being able to essentially set it and forget it, as the contributions can be taken automatically. Step 3 is to run payroll as usual, and remember that contributions will begin in January. This will mostly be achieved by using payroll software that employers already have, and we've worked closely with payroll software providers to finalize the specifications applicable. Employers who don't use payroll software will be able to download the APN and upload the contribution file through their account on the employer portal. A third option is to use submission screens on the portal to manually input employee pay details. Employers won't have to worry about who should or shouldn't be in MyFutureFund, as NAERSA will take care of all this. So employers will have some responsibilities, however. Automatic enrolment is an employment right set out in legislation, and there'll be a number of protections, including fines and penalties for employers who prevent their employees from opting in, rent them, or who force them to opt out or suspend contributions, or who penalize them for participation in the scheme. Any withheld or underpaid contributions will attract interest payments. And remember, contributions have to be paid no later than 6:30 p.m. on the employee's pay date. The penalties and fines for non-compliance are set out in legislation in Chapter 5 and Chapter 6. The objective of the measures in this part of the bill is to deter evasion and encourage prompt payments of arrears. Part 9 of the Automatic Enrolment Retirement Savings System Act provides for a range of powers to be provided to NAERSA to conduct its compliance and enforcement functions. But the first step employers should be taking is to ensure that they have registered and set up a payment method on the MyFutureFund employer portal before January 2026. It's very important that employers are aware of these obligations because non-compliant employers will face the risk of interest and fines and the possibility of prosecution. So there are some important benefits for employers, and a big one is that employers can ensure their employees are looked after in retirement without having to set up or administer a company pension scheme of their own. They can also increase their competitiveness and attractiveness as an employer in what is a very tight labour market. Also, it's important to highlight that employer contributions will be deductible for corporation tax purposes. There's a few things employers can do to prepare for the launch of MyFutureFund. The first is that they'll need to budget for the introduction of the scheme next year and in the years going forward. Now, it'll be clear to employers how many of their staff meet the age and earnings criteria, but don't forget that those earning below €20,000 a year and aged between 18 to 66 can also opt in. Employers will be asked to complete their profile on the employer portal before the system commences. And this means they'll have a direct line of communications with NAERSA. They'll be able to set up a variable direct debit or select another payment method. If employers operate a pension scheme in their business already, but not all of their employees are enrolled, it's very likely they could be enrolled in MyFutureFund. And this means they could have two schemes operating side by side. If there's a waiting period for the occupational pension scheme, employees could be enrolled in MyFutureFund during this time. Now, if this happens, employees subsequently want to join the other scheme, they'll be able to do so at any time. And although there shouldn't be any major problems with having MyFutureFund and another pension scheme, employers might prefer to have all their employees in the existing pension scheme and should therefore start talking to their employees now about joining that scheme. As I've said before, payroll software will be used to enroll employees. Closer to the launch of the scheme, payroll software companies will need to update their software to facilitate this. This will help to ensure that employees can be enrolled as smoothly and seamlessly as possible and that employers are compliant with their obligations. Under the auto-enrollment legislation, employers will need to inform employees directly when they've been enrolled. And to make this as easy as possible, we'll provide assets and advice to employers to help them fulfill this obligation. Now, there's a number of myths or pieces of misinformation about MyFutureFund. It's just important that employers and payroll operators have the correct information. So we're just going to go through a few of the most common myths now. So much has been made about the administrative burden of MyFutureFund. But the truth is, the vast majority of admin will be handled by NAERSA. And this includes identifying eligible employees, enrolling employees, managing opt-in, opt-out, suspension, and re-enrollment, leaving very little for employers to actually do. In fact, especially for businesses that don't already have a pension scheme, there'll be less administration work than setting up an occupational scheme themselves. Business and employers are understandably worried about an increase in costs. Contribution rates will be phased in gradually to make it easier for employers and employees to budget for the introduction of MyFutureFund. And while MyFutureFund does represent a modest increase in wage costs, as time goes on, the international evidence shows that contribution rates will largely be absorbed into normal pay negotiations. MyFutureFund is not going to replace a state pension. Instead, it will sit alongside and supplement it like any other private or occupational pension does. The state pension will remain the bedrock of the Irish pension system, and my future fund will be completely separate to the state pension. My future fund contributions will be in addition to PRSI contributions. The contributory state pension is calculated only on PRSI contributions and doesn't take anything else into account. Therefore, my future fund will have no effect on it. The non-contributory pension is means tested, and my future fund payments will be assessable, the same as they would be for any other pension payments. Now, there have been suggestions as well that the state may use my future fund savings for other purposes, especially if there's an economic downturn. It's important to say now that this is categorically not true. These savings are the personal property of the participants. This is laid out in legislation and provides constitutional protections, as with any private property. This means the state nor anyone else will be able to use those savings for any other purpose. So we get a lot of questions from employers and payroll operators, and I'm sure you can have a few more for us in a couple of minutes. But I just want to address some of the most common ones now. So as I explained earlier, a look-back period will be used to determine if a new employee with no earnings record meets the income threshold for auto-enrollment. The look-back period will begin when the employee's earnings are reported to revenue and will continue until NAERSA can establish if they're likely to meet the income threshold on a prorated basis. Once it's been established that they will meet the income threshold, and presuming that they meet the other eligibility criteria, NAERSA will send an APN to confirm that they've been enrolled. Contributions will then commence, but will not be backdated. From our discussions with revenue and payroll software developers, we understand that there's a large corrections process for tax. And this won't be the case for my future fund. Employers or payroll operators will have until 6:30 p.m. on the employee's pay date to make any changes to the contribution file. Once the deadline is reached, NAERSA will deduct contributions according to the latest contribution file. The contribution rate is set and at the same level for all employees, so there won't be any need to correct contribution percentages. If an employee has been over or underpaid in that period, employers can balance it in subsequent pay periods, and as the contribution is applied as a percentage, the MyFutureFund contributions will be rectified. Now, this might seem inflexible, but there's actually a very good reason for this. NAERSA will be sending the collected contributions to the investment managers as soon as possible so that employees don't miss out on any potential returns. And once they've been invested, it becomes very complicated to backpedal. We will, of course, have to divest in circumstances where a refund is due, but if we were doing this all the time because of corrections, it could end up costing the employee a lot in lost returns. So the cleanest way is to set a hard deadline. This does not mean, however, that incorrect information is submitted, for example, an incorrect PPSN, that NAERSA won't rectify that. Now, lastly, we're often asked if tax agents will be able to access the employer portal on their client's behalf, and luckily, this is a short answer. Yes. Tax agents will be able to use their ROS credentials that they already use for their clients to access the portal to manage MyFutureFund obligations on behalf of their employer, as they do on ROS for tax purposes. And just before we finish up, I just want to highlight these 4 points that employers might need to consider. In December, ahead of the launch of MyFutureFund, we'll be asking employers to complete their profile on the employer portal and to set up a variable direct debit before January. This is to ensure that when the scheme launches, there's no delay in the transfer of contributions from the employers to NAERSA. By registering when the facility opens, employers can make sure that they're compliant with auto-enrollment obligations and they don't run the risk of incurring fines or penalties. Employers that have not registered by January are running the risk of becoming non-compliant and accruing a debt on unpaid contributions, as well as potential prosecutions. Completing your profile will be quick and easy, taking only around 5 minutes. Also, there won't be any standards for existing pension schemes to meet when MyFutureFund is first introduced. Once there's a pension contribution from an employee or employer through the payroll, the employee won't be eligible for the scheme. However, in the future, when MyFutureFund contribution rates increase, standards will be developed in conjunction with the Pensions Authority. And this will be to ensure that no other pension scheme, or that to ensure that all other pension schemes are at least as favourable as MyFutureFund. Also, as I said before, there won't be a waiting period for MyFutureFund in the same way that the waiting periods exist for other schemes. However, there could be a period of time before an employee is enrolled so that it can be determined if they meet the €20,000 threshold. This will especially be the case for new employees with no earnings record with revenue. It's important to remember if an employee has multiple employments, the income from all of those employments will be assessed for the income threshold. And it's also important to note that earnings threshold of €20,000 is an enrolment trigger. Once an employee reaches the threshold, they'll be enrolled and they'll stay enrolled even if their income goes below €20,000 a year at any stage. So just before we finish up, our website, gov.ie/auto-enrollment, is the primary source of information available online. There are sections there for employees, employers, and another on frequently asked questions. We also have a latest news page with information on upcoming webinars that we're hosting and any progress of the project. We have a playlist of videos on the department's YouTube channel, and each video is less than 3 minutes long and covers a particular topic. So you can watch all the videos one after the other, or you can choose the topic you want to learn about. And if you do want to get in touch with us to ask us a question directly, you can do so at autoenrollment at welfare.ie.
Thanks, Paul. We're just going to pass over to
Yep.
Jennifer now.
Hi, everyone. I'm just going to focus on the next steps for the employers and the employees. So, as Paul mentioned, it's very important that when the portal becomes live in December 2025, it's important to register all employers on the portal and to make sure that to be compliant that it's done before January 2026. Now is a good time to issue communications to all your employees and inform them about auto-enrolment, or if you have a company pension scheme, to discuss the internal scheme with them so they have the choice of both options. It's important that they arrange for any employees that are going to go onto the company pension scheme that this is done December 2025, so they will be omitted from the auto-enrolment in January 2026. It's also important to make arrangements with your payroll process and your payroll cycle to include the filing of the return to NAERSA with each payroll run, and to also organise the payments that will be made on the same day as your net payments to staff. So if you're weekly paid, they'll be taken out on the weekly when the weekly net pay is done, or monthly, it'll be taken out on the same day as the monthly net payments. For employees, they need to register on the MyFutureFund employee portal, also so they can see their funds that are being deducted, they can see the pot at any time. They also need to make decisions now whether they want to, if there is an available company pension scheme, whether that they'll join the company pension scheme or if they wish to be auto-enrolled in January 2026. If they're availing of the company pension scheme, it's good to ensure that they opt in to this company scheme before December 2020 or before December, so that they won't be auto-enrolled in January 2026. The portal will give them the option to, if they are availing of auto-enrolment, to select their fund option. So there'll be a default option. You can choose low risk, medium risk, or high risk options. So it is beneficial to the employees to look into this and to go onto their portal and to decide which option they're going to take.